Hi guys, I'm Diana, your non-guru real talk property pal. Today we're diving into a hot topic, transferring your property investment into a limited company. Remember the video where we discussed the cash flow, tax benefits, and liability packs of a limited company setup? I'll pop the link up here. Now let's explore what it really means to incorporate your property portfolio. In this video, I'll be sharing with you some information to consider and possibly options that may help you make an informed decision. Let's get started. Some of these bits may sound technical. Just take notes or save the video anyway. They will be conversation starters or options you will want to consider at some point in the future, if not already. Transferring your properties is not as simple as making accounting adjustments where you transfer titles only in the books. You are deemed to actually have made a sale of the property at market value between you and the company. Now, disclaimer, I'm not a tax or financial advisor. I am an accountant, but not your accountant. So please seek professional guidance where you need to. Okay, implications. Capital gains tax. When you transfer your property to your limited company, it's seen as a sale at market value. That means you could be liable for CGT on the profit. Also be aware, there is what's called a dry bill, where if you dispose of an asset, you will still be liable for CGT even if you haven't received the actual funds. You still get the tax bill. There's also a downside to transfers if you have renovated or have been focusing on the BRR strategy. That's because you have increased the value of the property and so market value goes up for tax purposes. I think there could be other ways around it though. I don't want to get in trouble, so I don't know. Speak to your tax advisor. You've got financial and legal fees associated with change of ownership. Please be aware guys, you will need to let your lender know your intent before transfer of ownership. Not all high street lenders will agree, so speak to your broker first. You may then be able to move to a new lender if that's the case. You've also got stamp duty, land tax that the company is liable for upon acquisition of the property. As this will be deemed as a second property, it's not a primary home as a company cannot reside in a property. So you will be paying, or the company will be paying, a 3% stamp duty surcharge. This stamp duty calculator, I've put it up here for you, shows you different rates on the different property values. If you're buying a property that replaces your main residence though, as an individual that is, you don't have to pay the surcharge, the 3%, just your basic stamp duty. Can these risks be mitigated? Yes is the simple answer. There are a couple of ways others have managed to work around this process. First, business asset disposal relief. There is a relief where you will be paying CGT at the lower rate of 10% of your gain compared to your potential 20%. This applies if you've owned the property and operated it as a business. In the property world, there's a famous case, a Miss Ramsey case, where HMRC ruled that you are deemed as a business if you've been performing landlord duties for at least 20 hours a week on average. That's about maybe 4 or 5 properties. These activities include meeting and assisting tenants, carrying out repairs and maintenance, reviewing documentation, chasing rental payments. Where you have a letting agent as well carrying on work on your behalf, those hours count as yours. Now, you also need to be sure that if you're a sole trader or business or in a business partnership, you have been partnering or have been trading for at least 2 years. The next option would be business asset rollover relief. Here you may be able to delay paying any CGT if you dispose of business assets and plan to use the proceeds to buy other business assets. This is not any avoidance of CGT, but more a deferral. And to qualify, you must buy the new assets within 3 years of selling the old ones, and you must be trading when you sell the older assets and when you buy the new ones as well. Then there's Section 53 of the Finance Act. Companies may not need to pay stamp duty on transfer of an entire property portfolio. So if you transfer your full property portfolio into a limited company, as long as the partners are getting shares in exchange. So the business partners must be the same as the shareholders. Just be sure that the business was a partnership and you have kept all financial records and separate partnership bank accounts to be able to prove the partnership. By the way, I'm not here to tell you to avoid tax. No, I love taxes. I'm just here to give you my opinion on what's out there so you can make informed decisions of your own. Is it always worth it then? I personally would prefer to be in a limited company, but it depends on your personal situation, honestly. Let me explain. If you're a basic tax rate payer at 20%, other than the impact of mortgage costs, you might still be paying less tax as an individual compared to if you're running it as a company. Consider what your tax bracket is. Also, it depends on whether you need to use your profits right away or you'd like to reinvest them. Let's say you are a higher rate taxpayer and you have an annual profit of, let's say, 10,000, and you want to use all your profits. As an individual, you have your personal tax at 40%, so meaning your tax bill will be 4,000. As a company, you have corporation tax at 25%, so tax of 2,500. And then if you are using all your profits, if you're going to take out the tax as a dividend at 33.75%, you have a personal allowance of 1,000, okay? And your tax bill comes to 2,531. Now, final tax bill, if you're taking out all the profit as an individual, it's 4,000, and as a company, it's 5,000. So you see, you end up paying less tax if you're an individual. Also, something to consider, personal mortgages get processed a lot faster than company mortgages. So how quick do you need your transaction to go through? Then there's what's called the latent gain. If you have debt that's higher than the value of your portfolio, you may be asked to pay your CGT immediately or within 60 days of incorporation. Then in that case, you're unlikely to use those other reliefs we just mentioned before. There you have it, a deep dive into transferring properties into a limited company. It may not be an option for everyone, so consider all facts first. As always, I'm here to inform, not advise. Do your homework and consult professionals when needed. Thanks for watching, guys.